This episode is brought to you by Acrolis. Every small business is different, but most lenders only see a snapshot. Acrolis gives SMB lenders the cash flow analytics, borrower behavior, and peer context to fund more, faster, and with confidence. Visit acrolis.com to learn more. Hello, and welcome back to the Fintech Takes podcast. Today's episode is stablecoin themed. I have been wanting to have today's guest, James Wester, a longtime payment analyst and current analyst at Javelin, come back on the podcast for a while. He's been on before. I kind of think of him as my stablecoin correspondent, so to speak, because he is both knowledgeable about stablecoins, bullish on the future of stablecoins and crypto broadly as a payment technology, while also being extraordinarily knowledgeable about how non-crypto payments works, the history of how the payments industry has evolved, the factors that drove that evolution and why they're important to learn from. And all of that is very relevant as a collision of different types of expertise, because our topic today is Open Standard and the OUSD stablecoin that will at some point be launched by Open Standard. This, of course, is the group, consortium, nonprofit, we're not exactly sure what, organized by Stripe to issue a dollar-backed payment stablecoin that will functionally end up being a major competitor to USDC and Circle. James and I talk all about what we know, what we don't know, what we suspect might be true, the challenges we think that Open Standard and OUSD will face, and really kind of what lessons we can draw from the history of payments and consortiums in payments to help us understand where all of this might be going. Fascinating conversation. James, as you'll hear, is incredibly knowledgeable about all of these subjects. He's also just a ton of fun to bounce theories off of, an analyst in the truest sense of the word, and someone I've learned from for years. So without further ado, here is my conversation with James Wester. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, delighted once again to have our skeptical stablecoin correspondent, James Wester, join the podcast. James, good to see you.
Nice to see you. I'm glad I cause delight when I appear.
You absolutely do. In fact, so much so that I will tell you something. You are the hardest person to get on the Fintech Takes podcast, bar none. Like, you get the award for, I have to chase you more to come on the podcast than any other person. And I get it. Like, lots of stuff happening in stable coins. You're like a naturally charming and just like gregarious person that people want as much time from as possible.
Now you're just buttering me up at this point. I will come on anytime somebody says that I am delightful and gregarious.
Well, there you go. You can clip that for your family so that at least someone has said that about you.
It'll go on my bio, my LinkedIn bio. It was once called delightful and gregarious.
Yeah, that's right. That's right. That is what you are known for, at least around here. I am delighted to have you back. It feels like every time enough like things happen in stablecoin world that I'm just like, I have questions about this. I have questions about this. I have questions about this. I think I have to have James come on. So, bunch of different topics. I wanted to start with one that we might not even ever get away from for the entire course of this conversation, because there's lots of angles to it, which is Open Standard, the new, I don't know what word we're using, consortium.
So that's part of the discussion.
Yeah, like I don't even
call this
right. So maybe let's start at the most elemental level. Like, James, what is this? What are they doing? What's happening? What is this?
I feel like I'm going to fail right out of the gate because I'm not going to have a good answer. And the reason is because I think I've been burned a lot. I've been doing this a long time, and I can tell you the numbers of consortia, partnerships, membership organizations, whatever it is that I looked at and I thought, oh, that's a good idea. So
sure.
early in my career, I thought ISIS was a good idea, which I mean the contact.
You're taking us yeah. You're taking us back to not the bad terrorist
not
thing
the bad
that
ISIS,
also
which
people probably haven't heard of today, but the payments thing that people haven't heard of today.
Consortium between T-Mobile, AT&T, and Verizon. I think I
remember. We're going back into like payments nerd history here.
And they were going to create their own tap to pay. And I thought, wow, okay, that seems to make some sense. Let's see what's going on there. Sure. And I remember having conversations with them when they first started, and you never could find the right person who knew who to get you in touch with the real right person. So you'd go to a comms person who was based out of Seattle, and then you'd talk to somebody here in Dallas because they were with AT&T, and then there would be somebody with Verizon, and it never really took off. Now, there are a lot of reasons why that probably happened. Maybe they were too soon. Maybe it wasn't a great business model. But it was one of those things where when they first came together, that was a big news. That was the phone companies, the wireless companies are going to get into payments because they felt like we don't want to give any of that away. If we're going to be using our networks to facilitate payments, we want to get some money off of that. So we're going to form this consortium, and that's what we're going to do. And it took a long time to implode, but it did implode eventually. Yep. And I can't remember the name of the mascot that they came up with, but I will invite anybody who is listening to this, Google it, look for it. It's horrifying. Yeah. It was like a little pause terminal with eyes and arms, and it was anthropomorphized.
Forgot about that. They paid someone to design this. Yeah.
Somebody had to have designed that. And if you were the person who designed it, I'm sorry, I don't mean to be mean-spirited, but man, it was frightening. But that was after they became ISIS. ISIS became a word that we thought of in terms of terror. So they became SoftCard, and SoftCard then disappeared. And I don't know where their assets ended up going. I think it went to maybe Google, somebody like that.
That sounds about right. Yeah, or Samsung or someone. Yeah, someone bought them.
So then you get to MCX, Merchant Customer Exchange. Yep. That was going to be the thing where the largest merchants were going to come together. That was Target and Walmart and lots of other companies. They were going to form their own thing where they were going to route payments. They did some tests. They were actually, I think, based even here at one point, again, in North Texas. But they did some tests in Ohio through Wendy's. And this was going to be the thing that they were going to do. They were launched, I want to say, in 2016 or 2017 at Money 2020. Yep. It was a big deal. And that too imploded because you really didn't have what they were all complaining about was the same thing. We do not like to have standards that are being set by somebody else that are relatively opaque, and we're the ones who pay these fees for interchange, and we don't like that. So they started, fell apart. That one too, I don't know whatever happened to that. Chase Pay was actually kind of a thing like that, though it wasn't really a consortium. It was we owned both sides. So Chase, we were going to have this payment network that we were going to create, did not work. I've been burned because I actually thought MCX, I'm going to admit straight up, I thought MCX was an interesting idea. I thought, you know what? Merchants have been complaining for a long time. If you can put this together and you can fund it and you can create another rail, maybe we'll see what happens. So
you've been hurt basically.
I have been hurt. I have been hurt many times.
Okay.
And it's alternative rails that come along and you think, okay, this is what's going to work. And there's enough behind it. There are some smart people that are working there. Certainly they understand the challenges. This time it's going to work. So when I first saw the Open Standard thing, I have to admit, came out on July 1st. Odd to put a big announcement like that 3 days before July 4th. It's not a great time to be doing news stories. So I thought, okay, that's interesting. But it was a lot of names. The thing that really caught my eye, though, was first the networks. You had Visa, MasterCard, American Express, and Discover. That to me is actually a red flag. Yep. That's the kind of thing that anytime you have something like that where they're all working together. Now, I know you have EMV going back 30 years, and they were basically putting together a standard for chips and cards and stuff like that. Mm-hmm. But that's the kind of thing that if I'm a regulator, I look at that and I think, that I don't know that I like that.
Yeah.
That was one thing that kind of was a red flag.
Yeah.
But Visa came out with their statement saying, yes, we're going to support this. MasterCard came out with it basically saying we support all of these we support all these stable coins as well. But it kind of struck me as being a little bit I think red flag is probably a little too strong, but it was something that made me question a little bit. And then within 3 or 4 days, you started having some of the companies saying, we didn't actually sign up for this.
Yeah.
We didn't, I think it was Samsung was one. I think there was another Korean bank or technology company that said, this isn't really what we signed up for. We're not partners. And that's the part where, going back to what do we even call this? They're very careful in the announcement to not call anybody a partner.
Sure.
They are just companies that have agreed. So what does that mean? And I think what I find interesting about that is we don't really know like what the precise legal agreement is. Are there? You know, we don't know what things like they're supposed to be a new business model. They're supposed to be that gives reserve earnings, you know, allocates it differently amongst the partners, but they're not really called partners. They're supposed to be governance amongst the partners, but we don't know what that really means.
It's going to be governed by a board. Who's on the board?
Is it board seats? Who's voting? How do we control these things? That to me that's going back to that whole discussion about ISIS and MCX and everything else. That's really where the details matter. And that's where things either succeed or fall apart.
Yep.
And you also don't know, at least I don't know. And I've been a part of some of these things at other parts in my career and points in my career where I've had to do these partner announcements. You have to be really, really careful.
Yeah.
And those things take a long time. And if you have a partner and you are calling somebody a partner and you're announcing a partnership, it has to go through legal and compliance, and it has to go through all the people on the other side, and you have to agree here. And to do that through 140 different companies, I thought, wow, that has to be a really big deal. But there were no partner announcements. In other words, nothing ended up on somebody else's newsroom site saying we are now a partner. It just ended up on this one thing. So those are the things that I think it's a great idea. I will say, I think I called myself positively skeptical at one point when it first came out. I'm a little bit more sort of skeptical.
Sure.
But I think that there are some things about it that make it really, really interesting. It's just there are so many questions, and we don't even really have like a white paper at this point. We just have, hey, this is an open standard. This is something that we are going to do. This is a stablecoin we're going to put out. Here are companies that have said, sure, we'll support that. But we don't really have much beyond that. So, you know, to me, it's one of those signs where if you're a booster in the space and you really think it's a cool idea, this is going to confirm the idea that you think it's really cool. If it's one of those things that you're not a big fan of this, you're going to look at it and say, oh, I'm skeptical because I don't have enough details. It's almost as though we can cast all of the things that we want onto this announcement, and it's true. You know, is it a good thing? Yes, it is. It's true. Is it a bad thing? It probably is. It's true. And so that's the part where you can't really have that when you're trying to build something that is, you know, as serious as moving lots and lots of money. You really just have to have a whole lot of rules. So I don't know. It comes all the way back to your question. Terrible answer. What do we call it? I do not know.
What is this thing? I have no idea. I mean, just to add a couple points to what you said, I mean, I think I went from like positively skeptical to more skeptical over the course of that like holiday weekend when like the announcing.
The more you thought about it.
Well, and like the more the reporting came out where they're like, yeah, we don't know why we're listed on there. We never like agreed to there's some like kind of weird stuff. And then even like among the smaller participants who were listed, and this gets to your governance question, like I talked to multiple smaller companies in the space who knew they were going to be in the announcement, let's put it that way. But then I was asking them like, but do you know what it is you signed up for? And they're like, no. Like we signed up to find out at some point what this might be, right? Like sort of an option value on the future kind of a thing.
Exactly.
Like, if this becomes a thing, we would prefer to be on the inside of it. And, you know, it's, I guess, two things I'll flag with it. One is just as it relates to like MCX and Currency and ISIS and Softcard and all of these.
That's what I thank you.
Oh yeah, man.
You remember.
We were all kind of in payment analyst world at the time. I had a colleague who lived in Columbus, Ohio, and she went and tested it, and she was like,
no way. That's great.
It was okay. Yeah, it was great.
Yeah.
We wrote like a whole thing
that
about
is like
it. It
some
was
serious payment geek bona fides.
It was fantastic.
Currency.
Like,
wow.
I actually used Currency in the brief pilot it was in Columbus, Ohio. So it was, you know, you see these things that crop up from time to time. And I think that, you know, you sort of start to make a list of like, when has this worked and when has this not worked? And I think that, I guess philosophically, maybe one of the things that makes me concerned about a consortium is, unless this is like, our entire world will collapse unless we figure out a way to play nicely with each other and actually make this thing a real thing. It doesn't tend to usually happen. And I'll cite two counter examples that maybe sort of prove the point a little bit, right? One is like Zelle and EWS, right? And whether you want to say that P2P payments was like an existential threat to banks or not, like, oh my gosh, if we don't do something about Venmo, we're screwed. I can tell you that bank CEOs in those days felt like Venmo was an existential threat. And like they had the stuff, right? Like they had the consortium already built. They had the legal mechanisms already figured out. It's owned by the big banks, blah, blah, blah. And still, it took years and tons of capital calls and tons of money poured in by the big banks and tons of like almost mob-like behavior with smaller community banks going like, hey, that's a great community bank. It'd be a shame if anything happened to it. You should really sign up for Zelle. Like there was a lot of pressure and investment exerted over many years to make it a thing. And it was only like a thing because of how existentially terrified banks were of Venmo and then later Cash App. Like that's what made this a thing. It wasn't like, oh, maybe there's some hypothetical future where we want to get an option value on maybe being a part of it. Like that level of urgency doesn't drive consortiums to succeed. It needs like existential terror has been one observation I've had.
And what's interesting about that too, and that's a great example. So remember, Zelle started as Clear Exchange.
Yes.
Clear Exchange went for 4 years?
Yes.
Never really got any traction. Then they rebranded to Zelle. Zelle came out. And like you said, there was a lot more pressure and a lot more money, a lot more branding, a whole lot more support. What's interesting about that existential dread, though, in terms of P2P payments is it's not really a moneymaker, though. You know, it's like their fear was on all of that P2P, we can see that money going out to Venmo. We can see it going out to Cash App. We can see it going out to PayPal. We can see those monies moving out. But the moving in those apps isn't like, there's not like a huge amount of money that's being made. You know, I think you and I've even had this conversation about, you know, my kids have money that they send the same $100 around their group of friends. They send it hundreds of times, thousands of dollars in transaction volume. No real actual value has been accrued to anyone. That same $100 has just made it back around. And there hasn't really been any fee or anything, any other revenue. It's just money that's been sitting in an account. So with Zelle, it's kind of the same way. Yes, they have kept that money from moving out, which is good. You've kept those deposits in there, but is it something that is a huge revenue driver for the financial institutions that are participating? I don't know. Probably not so much, but it's important. And I love Zelle. I use it all the time. It is a very convenient thing because I don't have to move it out of my primary banking account. But I think your point is absolutely valid, which is it was seen as being something that we don't want to be unbundled, where somebody is just going to have this account that they can also pay their bills and use it as a primary bank account. We need to keep that here. Totally, absolutely right. The other ones, I think that slightly different, but still show that when banks work together, things can work, is Visa and Mastercard both started out as
right here. I just read this actually, which is D. Hawk's book, One from May, The Rise of Visa and Chaotic Organizations. And like two things to illustrate your point, because if you go back in history and you go back to like how credit cards worked in the late 60s and early 70s, it was, and it actually perfectly illustrates your point because it was a moneymaker. Like customers liked it. Merchants liked it. Like it was great. It worked well. It was like fantastic. But on a different level, it was an absolute fucking nightmare. It didn't work at all. You had to like literally, and I don't know if people realize this, but like in the early history of like Visa and Mastercard before they were formed and it was just individual banks running their own card associations, you would have like merchants mailing boxes of statements to the bank and the bank going through and like reconciling. Like it was awful. Like it was collapsing under its own weight. And so, you know, D. Hawk and a bunch of other executives from these banks get together and this is the other thing that kind of goes to like why this is so hard. I mean, my favorite part about this book is all the ways he describes like the tricky little ways he got them to agree to a thing that they probably wouldn't have agreed to in a different circumstance. Like he was a master of like organizational theory. He wrote a book on it. That's what a chaotic organization is. And like it was all born out of his experiences trying to fuse companies that don't want to cooperate together into a thing where they need to cooperate. And again, difference between now and then, because I've seen D-Hawk's name invoked a few times with Open Standard and kind of like, oh, this will just be like Visa again. Like, go back and look. Like, Visa was solving a hair on fire problem for a bunch of banks that were making a bunch of money on credit cards, but the system was collapsing under its own weight. And if they didn't do anything, they were all screwed. Like, existential dread once again.
Yep. And the other thing too is Visa and Mastercard at the time were nonprofits. They weren't built to make money. They were built basically, hey, we're just going to be a standard. We're going to help clear and settle all of this stuff. We are not actually trying to make a lot of money. That was not what they were trying to do. Now, after they went public in the 2000s, of course, they're absolutely phenomenal when it comes to organization and when it comes to doing what it is they do. But at the time when they were first formed, that wasn't what they were trying to do. I'm not clear on Open Standard if that's what they're trying to do. Are we just trying to be this clearing and settlement mechanism for this stable coin? Yeah. Is that what we're trying to do?
Is it a nonprofit? We don't know. Like, legal structure wise, like, we don't know.
Yeah, I'm not certain. And then the other thing that's so interesting about it too is at the time, you did have American Express, you had Diners Club. Those were charge cards. They were not necessarily rotating or revolving credit. Mm-hmm. But you didn't really have anything between the banks that allowed them to have those cards. And so it was brand new. We actually do have stablecoins. We have lots of stablecoins. We have an abundance of stablecoins right now.
Yes.
We have some that are actually working quite well. USDC works quite well. USDT works quite well. We know that all of these stablecoins are coming out. So the idea that we needed something that was going to say, we need to fix the way this mechanism is done, that's the other part. I'm not certain what I think, to my mind, the problem they are solving or looking to solve is what they conceive or what they look at as kind of an unfair way for Circle to have all of this money, to have all of these reserves, and to have all of this volume. So we want to be able to do it in a way so that those banks, those institutions, anybody else that is going to be clearing and settling these coins, they get a piece of it as well. So is the problem that we don't have anything? No, we have something. Is the problem we don't like what we have? That's kind of what it is. We want to see if we can create something that we like a little better. Okay. I don't know, though, that just saying you don't like it, I don't like use whatever metaphor you want. I don't like the food. I'm going to cook my own. Okay, well, now you've got to build a kitchen, train yourself how to cook, go buy all the ingredients. That is a very, very different thing. And
fill the kitchen with a bunch of cooks who kind of hate each other is the other thing, right? Like this is the thing with consortiums that's so hard, is that, like, the fundamental idea of a consortium is, under every other circumstance, we loathe each other and try as hard as we can to destroy each other. But in this one instance, we're going to set all those prejudices aside at the door and come into this kitchen, and we're going to cooperate and cook a great meal for all of our joint benefit. And that is really hard. So I want to build on what you described as, like, the reason behind this. And I'm going to start by just reading you text from a website. All right. Are you ready?
Yeah, I'm ready.
Okay. This is the homepage for a website for a company. The tech stack for the agentic economy. Build on the full stack platform, reaching hundreds of millions worldwide and supporting trillions in economic activity across on-chain and scaled financial systems. James Wester, whose website is that? This episode is brought to you by Acrolus. Most SMB lenders are making credit decisions on a snapshot. Raw cash flow numbers, no borrower behavior context, no sense of how that merchant compares to peers. Acrolus fixes that. Expect cash flow analytics, borrower behavior, and industry benchmarking, all built directly into the underwriting workflow. Visit acrolus.com to learn more.
The agentic part is what's throwing me, because so many of you have been talking about how they're going to do agentic. It could be, it sounds almost Visa-like. I've heard them say stuff like that.
Yep.
The full tech stack, though, would that be on a Fiserv FIS?
Kind of like them. Kind of like Stripe. Sounds Stripe-like, right? It's sort of developer-y.
Kind of in there.
Yeah.
I don't know.
I'll tell you what it is. It's Circle's homepage.
It's Circle's.
And what's so funny, the thing that just kills me about it is, like, it doesn't say stablecoin on there at all.
Yeah,
it doesn't say
yeah.
USDC. It says on chain. That's the only like reference to what Circle actually does. And it's funny. The reason I was looking at this is
that's really
going
funny.
to your point. I went to Circle's website and I was like, what does Circle conceive of themselves as, and what do they want others to conceive of them as? And I got to tell you, man, it looks exactly like Stripe's website. It looks and sounds like a knockoff of Stripe's website. And I think going to the point about like the motivation behind Open Standard, what it sounds like to me is all of these other companies, Stripe, Visa, Mastercard, American Express, Discover, US Bank, Google, Samsung, maybe or maybe not. All of these companies who basically believe that, rightly or wrongly, stablecoins, US dollar-backed payment stablecoins, will be a very important, perhaps the most important financial infrastructure or rail at some point in the future. And as such, we make a ton of money doing all these other things built on top of financial rails. And the thing we are worried about is essentially what Circle is broadcasting on its website, which is we are the full stack financial services operating platform for the future of agentic global economy, blah, blah, blah. And like, okay, we have a problem now if we're Stripe or Visa or Mastercard, because we conceive of ourselves as being that thing. But the problem is we don't issue the stablecoin that most people use for payments. And the company that does issue that stablecoin, if they didn't want to be any of those other things, if they just wanted to be a utility that just issues a stablecoin, plays nicely with others, and doesn't ever try to like lock anyone out of their ecosystem or control the whole stack, we wouldn't be doing this. It would be fine. But Circle obviously wants to be that company, and therefore we cannot have USDC be the only stablecoin that's used in regulated payment transactions around the world. And I think among the many companies who've joined, one name that we haven't mentioned yet, but is very telling in this respect, is Coinbase, who is ostensibly a member of Open Standard, whatever we mean when we say that. And it's pretty funny to me because like I've described Coinbase's relationship with Circle as like the modern equivalent of like medieval vassalage arrangements, where it's like you will give all of your money to us. Like it is a very profitable and very lucrative relationship for Coinbase that Coinbase shouldn't really have any like ostensible reason to want to get rid of or move off of. And in fact, I've heard they have the ability to like renew the partnership on these terms for a while still. And yet, Coinbase seems to have been at least somewhat convinced that these other companies might try to create an alternative to USDC, that they themselves were motivated to join this and at least get that option value on the future. So what do you think of my sort of theory that this is like all of these companies basically trying to stop Circle from vertically integrating on top of USDC?
I like that. I like it because one of the things that it wasn't just the American Express, Discover, Mastercard, and Visa, those four coming in. If you look at the technology providers that are also very, very, very fierce competitors, Fiserv, FIS, Jack Henry, and I'm missing one. There are several. There are a bunch of those technology players. And when you talk to them, they will say, we made a conscious decision to be a part of this because they talk about it in terms of optionality. We want to be able to make sure that we can support any coin that anybody wants to use, be that USDC, be that the Alex coin, be that OUSD, whatever it is, we want to be able to do that. So that to me is what's interesting is from a technology standpoint, they're not really saying we are going to support this as the thing that we want to issue and only issue and exclusively issue. We want to make sure that we can, if anybody wants to, we can absolutely move these coins. We can deal with these coins. So one I would look at would be, so the FIUSD, which is Fiserv's coin.
Yep.
Fiserv wants to be able to do that. It's very similar to what PYUSD is with PayPal. They can support that. They can support all of these things. PayPal not mentioned in the Open Standard.
Yeah. Yeah.
Because they have their own. But I think that's really interesting because I do think that what they are saying is, yes, there will be an option for you if you do not want to go to USDC. On the Coinbase side, what I would say there is, of course, I mean, what is Coinbase? Ultimately, Coinbase is an exchange. So they want as many coins as they possibly can. If there's volume going through, they want that volume to go through them. If there is a need, if there is a coin that's popular, if there are people that are going to be clearing and settling this coin, we are settling. We want to be able to be in that and a part of it. We want to have that ability. So I do think that that's a really interesting way to look at it, because one of the things that happens with a stablecoin is you do kind of, I won't say you collapse the stack, but you do sort of move a lot of pieces from the stack together. So with a stable coin, like most payments that happen now, you have a message. The message goes forward, hey, we're going to send this. That's the authorization part. Then the money moves after. With stable coins, the message and the money move together. So you basically kind of moved everything together. There is no message, then we clear, then we settle. It all goes at the same time. So what you're doing is, I don't know if you're moving things together into one stack or you're just taking bits and pieces out. And if you look at some of those players that are in that OUSD announcement, a lot of them would be the ones that would be taken out. We don't need a messaging service. We got the message once it moves with the once the coins move from one wallet to another, that's effectively the message right there, and it settles in the same transaction. So I think that's a really interesting way to look at it. What they are saying is, we do all of those pieces, and if something is going to be done, we want it to be this OUSD so that we can be a part of that as well. I think that's a really interesting way to look at it.
Yeah, I mean,
what I think though is, I think what's interesting is, so you have that kind of advantage of everybody together saying we're going to do that.
Sure.
But I think that becomes then the part that makes it a challenge.
Yeah.
Like we said, these are companies that don't get along well, or if they do get along well, they almost have to keep each other at arm's length, because you can't do too much to help others. Although it's so funny in payments. I mean, when you look at, for a long time, if you looked at companies that were in the acquiring space, their back end was actually being done by another company that was actually doing processing. Or, there might be a bank that's doing something that's actually running on other rails that are being provided by a technology provider that's integrated with another company. So
I just came across
a weird world.
I just came across an agentic payments, agentic commerce company that is like publicly talks about Stripe as like their competitor that they're trying to like compete with and go up against. But for stable coins, they use Bridge. And I was like, guys, Bridge is owned by Stripe. And Zach at Bridge is on their cap table. And it's like, okay, so like, I mean, this is, to your point, this is how payments tends to work. By nature, payments has to be cooperative, right? Like the money has to move and be authorized and settle between multiple parties. So there is some level of cooperation. The other thing that I'm curious about on stablecoins, and that what maybe OUSD points at a little bit, is this idea that, like, you mentioned before, there's all these stablecoins. I've been amazed by like just the blooming of 1,000 flowers in the desert. Like, it's just like, oh my gosh, look at all these. Everyone is coming out with a new stablecoin seemingly every day. And yet it seems as though, because of just the nature of kind of like, you take the reserves, you don't do anything crazy with them, you just hang on to them and earn the money on those reserves, and then you redeem them whenever someone comes back. Like, it's a very, very simple, straightforward model that is very sensitive to, obviously, interest rate conditions. And we've only really seen stablecoins as a modern industry exist in a relatively high interest rate environment. And it is a business where you're really not allowed to do anything kind of crazy with those reserves. That's the whole point. That's what's codified in the Genius Act. That's what Tether has maybe been accused over time of maybe not always totally doing. And so for like regulated payment stable use cases, I would make the argument that it's pretty hard to avoid kind of getting caught in a race to the bottom. And when I look at OUSD and its model of just giving all the reserves away, like, we are not trying to make money as Stripe, as the organizer of this new stablecoin initiative. Like, we just want to give all the revenue away to whoever distributes the stablecoins. It almost feels like Stripe's sort of pushing fast forward on we all know stablecoins is sort of a commoditized race to the market kind of business anyway. Let's just get through all the middle stuff right now and jump to that end state, which, by the way, we don't really care about because we're not trying to make money on stablecoins. We're just trying to not get locked out of this rail, and has the nice side benefit of being really bad for Circle, who still makes most of its money on that model. And if we can accelerate a decline in that model, and you saw this reflected in Circle's share price after this announcement, at least temporarily, like that would be, as a competitive thing aimed at Circle, a good thing to do.
Yeah. So in other words, they don't really necessarily need to compete and become larger than USDC. All they need to do is change those economics enough that you now change the economics of stablecoin distribution and use, that now it becomes a harder business unless you're doing other things.
Right.
That I could see as being, that's actually a really good way to look at it. And I think that's interesting too, because one thing we don't know is there is this management fee that's mentioned, less a management fee. And we don't know what that is. So is it going to be something that moving money over OUSD is going to still be just as expensive as it may or may not be? I don't know. I don't know anything about what it's going to be, but that does become interesting. Do you say, yeah, we're not trying to make money off of this yield, and yet this management fee actually is something that is good for us. We're making some good money off of this investment. We're making something off of it, and it becomes really good revenue. That I don't know. That's where I think a lot of this, there are so many questions that what I almost wonder is those of us who are asking all of these questions, we're actually sort of front running all of the objections and issues, so that when they do it, they're like, heard that, we solved that, heard that one, we've taken care of it. Oh, and we've addressed that as well. So it's like when it actually does launch, we're all just going to be like, that's perfect, man.
Right. You did all your homework in advance.
Free. You know, we've helped you actually build this model out. I almost hope that's the case, because it would be good since we've had all of these discussions about it.
Yeah. I mean, I think that's very possible. And I think the other thing that this kind of brings to mind, and part of this is like the governance discussion, and part of it is like sort of this cooperative, like we're going to do this at a very large scale sort of thing. We haven't mentioned Libra at all yet.
Oh, that was the other one. Oh,
that's the other one. That's the other decentralized one. Yeah. So maybe talk a little bit about
huge oversight on my part. That's
I'm glad you left it out, because now I get to bring it in this time. So when you were going through your like litany of like this never works in payments, Libra is the one we didn't talk about. So let's talk about that, because there's a lot of different potential lessons, I guess, to be learned from Libra. I think one of the biggest ones is like, don't be Facebook in 2019, which Stripe, check, like they're not Facebook in 2019. So they're good there. And I think, generally Stripe is just very well regarded as like almost a steward of the ecosystem in some senses. That sort of seems to be the way they like to conceive of themselves. So, but talk a little bit about, because Christian and others who were involved in Libra in the early days definitely weighed in on this announcement with a sort of Libra point of view in mind.
So Libra, am I supposed to give the primer on that fun one?
Give a little primer in case we have any newer listeners. Yeah.
Was it June in 2019?
I believe that's right. Yeah.
Yeah. So I remember getting a phone call. I was on a train from New York to Boston. I got a phone call from somebody saying, hey, this thing is coming out. It's called Libra. It's a consortium of 24, I think, partners. And we are going to create a stable coin, though it wasn't called a stable coin. I don't believe it was called a stable coin.
It was like they were saying things like baskets of currency. Do you remember that phrase?
And I remember saying, "Oh, that is the digital fiat that I have spoken."
Right.
What the hell is that? I'm like, okay, that one didn't take off, but it was even pre-stable coin, and the idea was they were going to take the reserves and invest them in this basket of coins, basically a basket of. They weren't real clear. And it was just a white paper. That was the other funny thing, is it was just a white paper and the partnership announcement. Yeah. And it was to have this coin that could work really for internet payments, but basically it was going to be internet money, the money that we were going to be able to move. It was going to be on a blockchain. It wasn't a whole lot. And I'm trying to remember now, I don't know that we had a whole lot of details on exactly how that was going to be done.
Not a ton.
Where it was going to be issued. We didn't have that many L1s at the time anyway.
Right.
But we had the standards to put it out. They were going to mint this token. They were going to be responsible for everything from mint to burn. They were going to be able to do things like, freeze and seize coins. It was supposed to be a relatively protected, safe way to do it, with the hope that they would be able to keep it pegged to a stable basket of currencies. And if you have enough currencies in the money market, the idea is they would all sort of balance themselves out. That's the James Wester version. There was a deeper white paper that was written on it. And it was kind of an interesting, compelling thing. On the train ride to New York, I get the phone call. Hey, have you read this? No, I'll read it. Later that afternoon, I get a phone call from a friend of mine who was a member, who worked at one of those partners, and called and said, we didn't say we were partners. Very similar thing. We said that we support something like this. Okay, so what does that mean? We don't know. I'll call you back. Within a few days, several of these partners started saying we actually weren't partners. And this was right after, as you said, Facebook 2019. I want to say this was right after the Cambridge.
I believe it was.
It was right when, I mean, they were in the crosshairs of every regulator and legislator. And that was when legislators started saying, we're going to subpoena all of you. Mark Zuckerberg, you're going to come here and you're going to tell us how you're going to have this magic internet money work. We think that this is a terrible idea. We think that it's all about, all of the things that we don't think that you're going to do well, like surveillance and, creating your own money. And it was just bad.
Yeah.
Sure enough, a couple of days after that all started happening, you started seeing companies start pulling out. I believe PayPal was one of the first, and Mastercard, and Visa, and they all said, look, we support it, but we don't really want to go as far as creating our own money. Fell apart. Then it became DM, and I actually don't know where that ended up. Did they end up being, did the bits and pieces of that, I can't remember who ended up acquiring
what's so funny about this is, like, in all of these kind of failed consortium ideas, there's always like a husk of IP left over that someone buys the husk and they kind of it gets acquired by somebody. There's probably some swag that comes with it.
There's exactly. There are a bunch of sweatshirts and a thumb drive. Here's
all the thinking on it. You take this and maybe you can keep the spark alive and whatever. But it is funny because, like, we didn't call it a stable coin. But it was, I think, very similar in scope, design, and in that initial execution of, like, here's a thing. We talked to these 140 companies. They told us they were in, so we were listing them on this thing, whether they actually are or not. Lots of questions about how it's actually going to work. And what I recall, I don't have the fun, like, being called on a train story of this. I was not.
That one it's one of my favorite stories, because it was like, I get a phone call in the morning and then I get a phone call in the afternoon saying, we're not real certain about this. It's like, wow, I didn't even have a chance to sit down, because I was in an event. I didn't even have a chance to sit down at a computer and type up a story or a post. It was like, oh man, I was composing it in my head. I never even got a chance to really write about it.
Totally. And it did go on this kind of, like, journey, obviously, post that there was, like, similar to ISIS, there was a rebrand that happened. Like, there were some things that happened. And I kind of recall Facebook being kind of as like helpful as they could possibly try to be to make it, like, viable, right? And so every time people would raise objections, they'd be like, no, we're going to do that. There's a way to seize money and return. Like, there's all these things. There's these controls. Here's how we'll provide visibility into it. Like, it really was, in a strict DeFi sense, it was, like, not decentralized at all, right? And the only sort of decentralization, I think, that was really prominently, like, made a part of it was, this isn't just Facebook. This is a consortium of lots of us, not just us. Don't be scared of this. The other, like, angle to it all, besides the partners being like, hey, we didn't really necessarily sign up for this. And I think what drove a lot of the, like, bailing on it over those kind of initial weeks was, in addition to Congress seeing a nice juicy morsel that they could have some hearings around, because Facebook did not have a good reputation at that moment. And wow, what a great excuse to get Mark Zuckerberg in a suit and have him come visit us.
Yeah, exactly.
The other part of it that was a little more behind the scenes, but was a huge deal, was central bankers around the world freaked out when this happened, like just spazzed out. And I talked to Mike Sue from the OCC, who was not at the OCC at the time, but was sort of within this ecosystem. And he was just like, like, you can't really, like, undercount just how freaked out all central bankers were about the idea of a large corporation saying, we are going to create digital currency that will be the future of commerce in this great and growing part of the world. And it was more than anything, even as Facebook tried to, like, soften it and tried to do good PR and tried to, like, do all these things to fix it, the lack of sort of acceptance by central bankers was in a lot of ways like the thing that was like, we're just never going to let this thing happen. Fast forward to 2026, and James, I have not heard of any central bankers freaking out about OUSD. This to me suggests just how far we've come in terms of central bankers and other regulators sort of wrapping their heads around the idea of stablecoins, accepting the idea of living in more of a world where there is private issuance of things that are kind of like currency functionally, and sort of figuring out how they can tolerate that world and how perhaps they can tolerate not living in a world where they get to be in charge of issuing a CBDC. That's just the centralized way that we answer this. And it really does feel like a reflection of how far we've come over the last 7 years. But what do you think about kind of the regulatory side of this? I'm sure Stripe probably ran it by some folks, but like I just haven't heard anything on that side of it at all.
First off, back to the idea that, yeah, we've come a long way. Absolutely. I do think this is a very different world. We understand that a stable coin like this. Now, there are still plenty of people who are going to say, oh, this is an absolute dream for money launderers and all the bad people who are going to use it. And there are a lot of people who are going to be anti-crypto regardless, and that's fine.
Yeah.
That's an education thing, and at some point it's just going to happen, and that skepticism will probably always live there, sort of low level. Oh, we always have to watch this for KYC and AML. Totally fine. But I do think that, yes, we've moved further along in terms of at least the way the financial services market looks at it and says, oh, this is an interesting thing. Maybe we can use it because it is not, quote unquote, crypto. It is something qualitatively different.
Yeah.
So that makes a lot of sense. What I would say, though, is because we are now talking about stablecoins not being tied to a basket, this will be tied to US dollars. US dollars will be sitting in a reserve fund. Central bank money will be sitting somewhere. Will be tied to that. That's a little bit different because what it says is this is a digital representation of a dollar, not some basket of whatever.
Right. We're not even really trying to pretend like this is a global currency basket of currency. Like this is just a different way to hold US dollars.
It will sit somewhere, and if you want to pay with it on a cross-border remittance, you want to pay a vendor in China, you want to pay somebody somewhere, and they want a dollar-denominated asset, they are going to hold on to this OUSD just like they would be USDC or USDT or PYUSD or anything else. Mm-hmm. It's dollar-denominated. It's dollars, effectively. What we are seeing, though, is, yes, the EU is very quickly moving forward, though, with what they are going to have as a CBDC, which is going to be what they consider to be a euro version of it, but is central bank controlled. Yep. And yes, BIS is also looking at things where their Project Agora and some other things are looking at how do we make central bank money tokenized so that we can at least do interchange across central banks. So they are kind of doing their own thing. I do think that it is a representation, yes, that regulators and central banks and others understand the tech better. But the idea that, this is going to be something that they're going to say in the EU, this is acceptable and we like it. No, they want to make sure that the euro has some version of it, even if they have to push it along themselves to say we are going to be issuing our own digital euro, which is effectively a CBDC, a central bank digital currency.
It is kind of funny to think that like the Fed and U.S. regulators have to some degree changed their mind on this because it's like, oh, well, at least you're using US dollars. Like, okay.
Exactly. We don't need to do a CBDC. It's dollars.
Right,
it's fine.
Right. It's going to be dollars, then like we're okay.
To have our dollars out there. It's great. And it becomes a good market for treasuries. It becomes if you need to back up all of these coins, go buy treasuries because that's what you're going to have in your reserves. So it is very different in terms of the way that, especially now that we understand, and I say the way we understand, the way they will be constructed. We understand the way that they will be constructed because post-Genius, this is the only way that they will be constructed.
It's mandated.
They must have that one backing with a dollar-denominated asset. So that makes sense. Yeah. We're not going to be doing any sort of algorithmic nonsense or weirdness. So I agree. I think it's just that U.S. regulators have said, okay, if it's going to be a certain way and it's going to be dollars, that's great. We want that because it's good for the dollar. But one thing I will say that we haven't really talked very much about is this idea of, and mentioning Libra and others and how those things were going to be built out and all of those coins. When we talk about we need an open standard for this, and it's called Open Standard. I mean, all of these changes are open standards. There's nothing hidden. Anybody can go build the coin. So the idea, you can mint your own stablecoin on open standards across these chains, because that's the point of them, is they are all open. So I do kind of find it a little bit funny that when we start talking about this is an open standard for a stablecoin, well, their standards are all open for stablecoins. Depends on what you want to put it on. So the idea that we have now sort of co-opted that language and said, oh, no, this is an open coin standard. It's like, okay, I get it. But it is sort of interesting because we are now across all of these stable coins that are coming out, whether it's, and it's not just PayPal or FIUSD or I believe MoneyGram has their own. I believe, who was the other day that came out with their own? Said they were going to do their own. And I was like, okay.
Western Union, maybe. Yeah.
Or Western Union. That was it.
Yeah.
Those are the things where what it's really going to boil down to is not going to be whether it is open or closed or, all of these different all these exchanges, organizations, financial technology companies. I've talked to a bunch of the ones that do the payment processing, and all of them have said the same thing, which is we look at stablecoins as a payment rail. We know how to move payments. That's what we're going to do. We are going to treat them all the same. We will clear and settle. We will move. I keep saying clear and settle. It's just, we will move those coins. We will support them. We'll be able to orchestrate across them. So the idea that we need a standards really are just, it's a group of people all coming together saying, yeah, we're all going to do the thing the same way. It doesn't have anything, though, to do with volume or demand or who's going to use it or why they're going to use it or where they're going to, actually have the applications and use cases for where these things are going to work, or why they're going to work or basically it doesn't necessarily say any one of them is going to win. So I do find it kind of funny, the idea that, we've had all of these stable coins. We're going to be the open one. Well, they're all open too. It doesn't take anything. It's not as though they're hidden in secret and we now are the one that, we're coming out with this coin that is the more transparent, the more, it's just not that way. So that's where I find all of this so interesting is ultimately what we really need to be figuring out is the applications and use cases themselves. Who's going to use them? Right. And at the moment, there's there's some use cases for them, cross-border remittances and things like that. But we've got a long way to go. When you look at the actual volume of transactions in terms of real value, not just arbitrage or wash trading or anything like that, it's still a very, very small amount compared to total payment volume.
It's tiny. And I think two last thoughts to sort of add on to that. I mean, one is that you're right about the open standard thing. Like, I get what you're doing in terms of trying to convey this idea of like open governance, but it's open governance among a group of companies that are teaming up to destroy a different company that they're threatened by. Like, let's not pretend this is like open technology standard setting early days of the World Wide Web or the Satoshi white paper. Like, this isn't that. This is a commercial enterprise to try to destroy a company that you are threatened by. Let's just call it what it is. Like, let's call it like all the little brothers team up on Big Brother standard. Like that's like what we're doing here. So that I think is a good point. And then the other one that just I think is worth kind of referencing as a difference on all of this is you're right about the stablecoin kind of payment volume. Like, it's still very, very small in terms of real economic activity. And I think the other company that we've referenced a couple of times but haven't really talked about is like Tether is just sitting off over here going like, cool, have fun. And my observation of Tether has been that, if you think about like the main categories of use cases for stablecoins, the ones that are harder to see real immediate volume, like translating in the short term, long term, possibly yes. And you and I have talked about this before, but like, in the short term, the opportunity for stablecoins is let's go find everyone who wants to hold US dollars but can't for various reasons and sell them a thing that we're not going to pay them yield. We're just going to keep the money. Like, we don't even really have to be all that regulated. And like, that is a massive short-term opportunity that the sense I get is that Tether feels like they own that and they don't even really have to like compete that hard to continue to own it. And so it is just a good reminder that within the world of stablecoins, the thing that Stripe and Visa and Mastercard and Discover and Amex and Coinbase and all these companies are teaming up on is going after a relatively small and very competitive part of an ecosystem that is not even close to being what it will eventually be. So it's good to just keep it in that broader context, I think.
Yeah. And I do think also, going back to the very beginning when we were talking about, we don't have a whole lot of details.
Yeah.
We don't have a whole lot that we know about it. All of that stuff you're talking about with Tether, all of that stuff you're talking about with Circle 2, where the part that we don't know anything about, and it really is where a lot of this will live or die, is in that what chains, where's it going to be listed, the market makers, the liquidity, the cross-chain stuff, all of that stuff is going to really, really matter. And that's the part where I think it's going to be interesting to see how all of these companies that are also going to compete for that too. There are a lot of banks that are listed on there. Wouldn't they love to be able to do any of that? Would they like to be a market maker? Would they like to handle some of the liquidity? Would they also like to do some of the commercial payments? Would they like to do all? That's the part where I think this is going to be very, very interesting, because I think it is going to shine a bright light on where a company like Circle has this business that they know and they're doing well, and they're actually taking care of this very, you can call it small. It's not small. They're actually growing quite large, but they've got their part of it and they've understood it and they're doing what they're doing. You've got, Tether over here doing what they're doing. And what I think it's going to do is it's going to shine a bright light on just how complex and weird, and back to what we were talking about, where this partner is actually doing this part for this partner, even though they're a competitor of this bank that does all that. That's just the way the payments works. And I think what's going to be interesting to see is, if they make this work, how do they make it work where all of those relationships are happening across all of these many, many, many different payment applications and use cases, from commercial to small business to capital markets to remittances to payouts to gig economy. It's, when we talk about stablecoins and deposit tokens and real world asset tokenization and everything else, when we start talking about how it's going to rewire the payment stack, it's an easy thing to say until you start unpacking what that means and you realize this is generational. This is not going to be something that an announcement on Tuesday, July 1st, 2026 is suddenly going to lock it all into place. We have a whole lot that we don't even understand what's going to happen yet. And I think there are a whole lot of players that haven't even weighed in yet, especially even from like a regulatory standpoint.
Yeah, I think there's a lot more to come there. And I will say, on your point about generational project, it's another reason why, timing is good now, because a lot of this has been built. We know what this looks like. People are more comfortable with it. And Stripe, for all of the, I think very fair critiques and concerns that you can have about the way this was rolled out and the number of things we don't know yet. One thing I do know about Stripe is they do tend to think generationally. Like, they think over very long terms. And so I'm sure they've studied the history of DHawk and Visa. I'm sure that and Libra, and I'm sure they're very aware of all of these things that have happened before and how to solve for them. So will be an interesting one to watch. We will have you come back to talk more about when we know more about this. If I can convince you to come back on the podcast, if I can get through all your schedulers. Okay. All right. I appreciate it.
This is a fun discussion.
No, it was great. And we actually left a lot of other non-OUSD topics on the bone as well. So we'll have you come back again soon. James, thank you so much. As always, this is fun.
Thanks for having me on. Always a blast.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.